2015 is going to go down in the books as one of the best years ever for the U.S. apartment market, and we're going to look at the results for that year today. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons. He's Greg Willett. And Greg, the last few months of the year, they always tend to be seasonally weak. The weather, slower leasing period. But in 2015, in fourth quarter, we really didn't give up too much ground.
It was a pretty typical fourth quarter, and we did see occupancy back up a little bit, 40 basis points. That's not unusual. And rent change actually slightly negative, minus 0.1%. So again, that steady to slightly down on the rent numbers, pretty normal.
But the big story probably is the annual rent growth.
Yeah, it really is. I mean, this big story for the year is just how awesome those calendar year numbers, even with that slight back ticking in fourth quarter.
And let's take a look at those numbers. That's definitely the headline number. We ended 2015 with effective rents for new leases up 4.8%, and that's now the sixth straight year of notable rent growth for new leases. And you put those 6 years together, that's cumulative rent growth of 22.5% over that time frame. So obviously a substantial number. Renewal lease price growth also looked substantial in Q4. Renters who renewed their leases in that period are now paying 5% more versus their previous lease. And the share of expiring leases that end up being renewed came in at 50.4%, and that is up year over year. So that continues a trend of renters being more and more likely to renew their leases and staying put as opposed to moving on. So retention rates are still above what we saw in the previous cycles.
Helping us get those big rent growth numbers, the occupancy story is still really, really strong. The average occupancy rate for the U.S. as a whole as of fourth quarter is 95.8%. As we said, again, down a little bit on a quarterly basis, but still up year over year, up 30 basis points on an annual basis. And so let's look at the supply-demand numbers. How did we actually get to that occupancy figure? And this is a really interesting part of the story, particularly when we look at that supply story. Now, we came into 2015. We were scheduled to deliver right at 300,000 units. Lots of construction delays, and that were really tied to mostly labor shortages. Every quarter we seem to run a little bit short of deliveries actually hitting what they were scheduled to be, so we only finished 232,168 units in calendar 2015. So we didn't get the 20% bump in completions that we were scheduled to get. And in fact, completions came down about 8% from the 2014 number. So with that delayed delivery situation, it was pretty easy for demand to keep up with the building pace. So we had absorption of 249,256 units, well above that completion number.
And obviously, Greg, developers don't like delays, but the one upside with delays is that does allow more time for pre-leasing, and so that does help the overall market stats. So thus, occupancy in the top-tier product really didn't dip down as much as we had projected it to, and in turn, rent growth held up better than expected as well. Also, delivery delays in 2015, what that really means is we're going to see more supply coming in the first 3 months of the year than had previously been expected, and also that means that we're going to see a lot more supply in 2016 compared to what we saw in 2015. We are now up to 443,240 units under construction at the end of the year. And of those, we have 311,511 units that are projected to complete in 2016. And so what that means is that we could potentially have new supply that's about a third higher than what we saw in 2015, which is already an elevated number.
So again, we think the number will be big on deliveries in 2016. Is it really going to hit 300,000 plus? We'll see. Again, some of them, though, those will be delayed. But we are going to deliver enough that we do think that occupancy will start to backtrack a little bit. Our first run through on the analysis suggests about a 50 basis point drop in the occupancy rate, but that would still leave the number in really good shape and, in fact, above the long-term average. Similar story when we look at the rent growth expectations. We'll slow down a little bit from where we were in 2015, but still with a really solid number. Our first look at these results suggest about 4.1% rent growth for new leases. We'll fine tune it. We might end up in the high 3% range, somewhere right around that 4% mark.
Certainly still a very favorable outlook compared to long-term norms. So that's going to wrap us up for the big picture overview of the U.S. apartment market. We'll be back next time with the always popular look at the rent growth leaderboard for calendar 2015. And then, of course, we'll dive into all of our metro highlights as well. So until then, for Greg Willett, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics from NPF Research.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.